Okay, so hopefully I have convinced you here, and I'm going to continue to work to do so, that diversification is usually a good idea. Okay? Now, I want to explain a little bit here about what happens to the risk and the return of a portfolio as we add more and more stocks to it. So for this example, what I would like to do is pretend that we're just going to build us a big stock portfolio one at a time. So we're just going to start randomly picking stocks and adding them to our portfolio. Maybe we take the Wall Street Journal, the investing section, the one that lists all the different stocks and how they've performed, and we just put that up on the wall and start throwing darts at it. So the first dart that lands on it is going to be our first stock in the portfolio. The second stock will correspond to the second dart, and so on. Well, what do you think is going to be the expected return and the standard deviation of that portfolio, or how do you think it's going to behave as we form the portfolio by adding more and more stocks to it? What about just the first stock? What do you think that it would look like after we've just picked our first stock? Now that shouldn't be too hard to answer that question, because we've said before that the average rate of return on a stock is it's in the 10 to 12% neighborhood. Okay, and then a few minutes ago, actually in the previous lesson, we said that the standard deviation for any just any randomly chosen stock probably would be about 35%. So if the whole class randomly picked their own stock off the pages of the Wall Street Journal and then computed its standard deviation, obviously some of us would get more than 35%, some of us would get less, but our numbers would probably average out to about that much anyway. So what would happen if we started adding more stocks to the portfolio, though, in the same manner? We're just picking them at random. So we've picked our first stock. Let's pick a second one at random. Well, chances are that it too, on average, will have a 10 to 12% expected rate of return with a 35% standard deviation. So what will the portfolio then begin to look like? What do you think the expected return of the portfolio will be? Well, don't think too hard about it, okay? You've got one stock that has an expected return of 10 to 12%, and you've got a second stock with an expected return of 10 to 12%, and since the expected return of the portfolio would just be a weighted average of the two, then it would be 10 to 12% for the portfolio as well. That's an easy one, okay? But remember that standard deviation doesn't work like that. Remember I said, and in fact I gave you this example earlier, but we worked through this example where we saw that the standard deviation of the portfolio was actually considerably less than the weighted average of the components of the portfolio. And in fact, that would be true in this case as well. You see, each stock on average would have a standard deviation of about 35%, but together as a portfolio, even though individually the stocks would each have about a 35% standard deviation, as a portfolio together they would most likely have considerably less than that, or at least somewhat less than that. So now that would not do anything to the expected return. Remember that the expected return of the portfolio is still going to be in that average range of 10 to 12%, and that will not decline as we add more and more stocks to the portfolio. But the standard deviation, however, will decline as we add more and more. And the reason why is because they're not perfectly correlated with each other. Okay? These stocks do not all do the same things on the same days and even in the same years. You may have times when one stock doesn't do well. Obviously, those times will come. But the good thing is that in at least some of those times, you will have other stocks in the portfolio that make up for that poor performance to some extent. You will have other stocks in the portfolio that perhaps even do better than average. So these additional stocks that you add in will smooth out the fluctuations at least a little bit of the other stocks and thereby reduce the risk of the portfolio. So that definitely is a good reason to build a diversified portfolio and not just pile everything that is all your money into one stock. Let's suppose that I just keep doing this. All right. Let's suppose that I don't stop with one or two stocks or even 10, but I go and I do 20, 30, 40, for that matter, maybe a few hundred or even a few thousand stocks. And in fact, I personally actually do this. I have a particular mutual fund that I invest in pretty often that owns little slices of thousands of different companies. So essentially owning a little piece of all of the publicly traded stocks, or at least almost all of them, in the U.S. stock markets. Now that is very diversified, right? That's thousands of firms and not just a few. However, as you pass a certain point, okay, when you get up into that range, it certainly doesn't hurt you any to add additional stocks. It's not like your risk is going to start to go up on your portfolio because you've gotten too many stocks in it. It's not like that. But the added benefit of diversification, it starts to level off a bit. It starts to dissipate. So let me show you graphically what I'm referring to here. You see, with your first stock in the portfolio, okay, you would have an average risk of about 35% here, okay? So again, with your first stock, you'd be about right here, and that'd be your portfolio risk because that'd be the only stock in it. Then when you get your second stock, you move down to about right here, okay? Maybe you're down getting closer to 32 or 31%. You get 5 stocks and your risk level's down to here. 10 stocks, you're down in the lower 20s. 20, 30, 40 stocks. You see what's happening here? While the risk is declining ever so slightly at these higher levels, it's not declining nearly as much as it did at first. And in fact, you can go as far as you want. You can do something kind of like my mutual fund that I invest in, and you can buy thousands of different stocks. But there comes a point where there's a certain level of risk that you really can't get rid of much more than that. Okay. And these numbers are estimates, but that level is roughly 20% or so. Okay, about 20% would be your portfolio standard deviation if you were really, really well diversified. Certainly here, there is some serious benefit to diversification. I mean, this component of risk right here, basically this region, you've gotten rid of this part of the risk. But there is a part that remains. Okay, no matter how many stocks you add to the portfolio, there's a portion of the risk which we call market risk, and it's represented by this green shaded region, that you can't get rid of this risk no matter how many stocks you add to the portfolio. I would like for us to try to understand this a little bit better now, okay? So the total standalone risk of a stock can be thought of as two components. There's market risk and there's diversifiable risk. The market risk, I must apologize in advance, these two different kinds of risk actually go by two different, or not two different names, but several different names. And I want you to be familiar with all of these terms, and I want you to jot these down in your notes, not only because they're likely to show up on quizzes and exams and such, but also because when you read about them, you know, in say investment related articles, or you know, just wherever you might run into it, you're about equally likely to hear any of these different names. So it's good for you to know about them. Market risk is referred to also as systematic risk because it pertains to risk that is system-wide and affects the entire financial system instead of just one firm. Excuse me. It is also referred to as non-diversifiable risk because, you know, for obvious reasons, you can't diversify it away. It's the type that remains no matter how many stocks you add to your portfolio. And for reasons that we will discuss shortly, it's also called beta risk. The diversifiable risk, that's the other kind, is also referred to as unsystematic risk or non-systematic risk because it's not related to the entire financial system. It is also called firm-specific risk or company-specific risk, same thing, okay? And it's also called idiosyncratic risk. Idiosyncratic. And idiosyncrasy is something peculiar, something unique about an individual, or in this case, a company. And that's actually where this type of risk comes from. Let's talk about these two in a little bit more detail. First, the market risk. Okay, the market risk, as we said, is the type of risk that cannot be eliminated just by diversifying. And as we're going to see a little bit later, we measure this by a beta coefficient, and that's why we sometimes call it beta risk. The market risk comes from risk factors that affect the entire economy. So let's say inflation takes a strong upward turn, or let's say there is a global recession. Will that affect just one or two companies at a time so that we can diversify that away? Well, no. I mean, by the words global recession, obviously that's something that's economy-wide for sure. And it doesn't matter how many stocks I invest in. If a global recession hits, well then all of my portfolio is going to be affected in a significant way. And so these sorts of risk factors cannot simply be diversified away. They are market-wide, and it doesn't matter really whether I have 5,000 stocks. No matter how well diversified I am, I know that these things are going to affect my portfolio still. That's why some risk still remains. Now about the diversifiable risk, whereas the market risk comes from macro level risk factors, diversifiable risk comes from micro level factors. That is, things that just affect one company at a time, one firm at a time. So think about the risk that for example, a company's CEO might die or resign unexpectedly or suddenly, or let's say that the risk that a localized disaster or maybe even just something as simple as a fire would destroy the production facilities of a particular company. Are those risk factors? Yes, of course they are. And if they were to happen, could they adversely affect the performance of that one company? Oh, yeah, and maybe significantly so. And if you've piled all of your money into that one firm, then it could be a big deal for you. You could lose a whole lot. But will they affect the entire economy? No, not at all. Okay? In fact, it probably won't affect too much beyond just that one firm, and maybe a few companies if they are are in a close business relationship with them. Maybe they're a key supplier or a key customer. But beyond that, really, it shouldn't be very much at all. That kind of risk is definitely diversifiable. And let's say that something horrible happened that completely wiped one company off the map. If I had invested all my money in that company's stock, then I'd be in big trouble. I would have lost everything. But if I have invested in, say, 5,000 stocks, then, it's not that big of a deal to me because it's not an economy-wide thing. It's just that one particular company, and it's 1/5,000th of my portfolio. And for every company that something bad like that happens unexpectedly to it, there's probably going to be another company where something good unexpectedly happens. Maybe a pharmaceutical company that just got approval for a great new product. A drug that's going to help a lot of patients and be very profitable for the shareholders. So this diversifiable risk comes from these uncertainties about what's going to happen at the micro level. But that stuff will average out. For these firm-specific events, you'll have some firms that have bad things happen to them individually, but for every one of those, there'll tend to be another one where good things happen to it on an individual basis. So again, that will average out, the good and the bad, but the market risk remains. That part I cannot run away from just by diversifying. So we've established now that there are two different kinds of risk, one that can be diversified away and one that cannot be. So what if I decided, forget diversification. I don't really want to do that. I think I really just want to pile everything into one company and try to get rich that way. Okay, would I bear extra risk doing a strategy like that? Well, you bet I would. Okay, there isn't any question about it. Choosing to pile everything into one stock is a considerably more risky strategy than holding a diversified portfolio. And in fact, I would venture to say that that would be frowned upon by the vast majority of financial advisors. I certainly would not be comfortable doing something like that with my own money for fear that one company I chose would turn into the next Enron. There's always a small chance that something like that could happen, but if it does, then it's a big disaster for you. So the question is, would I be compensated for bearing that extra risk? Well, and the answer to that question is pretty much no. All right, unless I am putting my money into that one stock because I know something about that stock, or I have analyzed the available information about that stock more effectively than other investors have been able to. And let's face it, that's very, very hard to do. Um, in the absence of those things, the answer is no. I would not, on average, expect to earn higher returns for choosing to take on that risk. And in fact, if I choose not to diversify, then I have basically behaved irrationally as an investor. I have made an unwise decision that I should not really expect any compensation for. I should not expect to earn a risk premium. This is just extra risk that I have voluntarily chosen to bear. And that's unless there's some very special, unusual circumstance, that would not be a wise move on my part. So, what kind of risk matters then? Well, it's the kind that you can't just freely get rid of. It's market risk. Okay, the standalone risk, while we do talk about it, all right, and we still know how to calculate it, we're not going to completely ignore it. It's not so much the standalone risk that is relevant to a well-diversified investor. Instead, it's that market risk. It's that specific component of risk that can't easily be gotten rid of. Okay, that's what we're going to focus on from this point on. And in fact, that brings us to the capital asset pricing model, which links the market risk of an investment with the required return on that investment. Okay, the CAPM, or the capital asset pricing model, and by the way, sometimes we'll call the graphical relationship of this equation you see here, we'll call it the security market line equation, or the SML. So anytime you hear me refer to the CAPM or the SML, I'm basically talking about the same thing. The relationship here says that the required return on a stock, okay, the required return on a stock should be a function of several things. We've got the risk-free rate of interest. Okay, obviously I want to earn at least that much. I mean, if I'm investing in something that's risky, then at a bare minimum I want the risk-free rate of return, but I also want more than that. Okay, because I'm taking additional risk, and in particular I'm taking I have market risk even after I've diversified well. Because I have extra risk, I should expect a higher rate of return. Otherwise, I won't take that risk. Okay, and this extra over here, this term, is actually the risk premium for this particular stock. Now, how much is this risk premium going to be in particular? Well, it's going to be determined by this thing that I'm circling here in parentheses is called the market risk premium. That's a special term, the market risk premium, RM minus the risk-free rate of return. The market risk premium, all right, this RM here is the market rate of return, the expected rate of return on the market, the required rate of return on the market. It would be like the average rate of return on my 5,000 or 6,000 stock mutual fund. Okay, basically my my fund that invests in every possible stock in the market, or pretty much close to it. That's what we call the market portfolio. And RM is the average rate of return on the market portfolio. It's higher than the risk-free rate of return because, remember, even the market portfolio has some risk associated with it that we can't diversify away. I promise you that risk is there because there have been years when I've lost money on that portfolio. And then there have been other years that I've made money on the portfolio. But there are fluctuations. There's no doubt about it. So it is not risk-free. And so the reason I take the risk is because on average, the market return is higher than this risk-free rate of return. The difference between the two, okay, that extra that I get on average for investing in the market portfolio is called the market risk premium, and that's what I've circled here, okay? Now, as for the individual stock, some stocks have market risk that's more or less than average, okay? And this beta is the measure of a stock's market risk, okay? The non-diversifiable kind. So stocks with a lot of market risk will have a higher risk premium, okay? And that makes sense. They should. Stocks that are especially sensitive to the market and fluctuate more with along with the market should have a higher rate of return over time in order to attract investors. It's got to compensate for that additional fluctuation somehow. And stocks that are not so risky, okay, they have less market risk. They don't tend to bounce around as much in response to market conditions. Those do not have to command quite as much of a risk premium, and that makes sense too. Okay, if you want a stock with low market risk, you can get that. The only problem is that it won't have as high of an average rate of return. Okay, it won't have as high of a return from year to year, at least if you take an average over long periods of time. On the other hand, if you want to shoot for a stock that has a high expected rate of return, you can get that too. You'll just have to accept more market risk, so more year-to-year fluctuations. So it's always a trade-off in finance, right? Or at least almost always. Anytime that you want a higher rate of return, you can usually get that if you're willing to take more risk. But if you are, or you can get that on average over time, I should say. But if you want safety, you can get that too, but you'll have to accept a lower rate of return each year. So anyway, this relationship, the CAPM, is quite important. The CAPM, the security market line, we are going to be discussing this a lot more throughout the rest of this chapter and throughout even several chapters to come. So it's going to be a major theme for the rest of the course, and you'll definitely want to understand very well how it works and how to use it.